In the crazy world of AI, a new powerhouse is moving at like lightning speed. We're going to do a deep dive today on a company called Nebius. These are the guys building the massive cloud infrastructure that actually powers all this AI. And we're going to explore why this might just be one of the most important and maybe even undervalued plays in the entire AI revolution.
All right, let's just start with the number that, honestly, it'll stop you in your tracks. $17.4 billion.
So what is that? Well, that's the size of the massive contract Nebius just signed with Microsoft. And look, this single deal, it didn't just put them on the map. It completely changed their entire trajectory. It basically validated them as a go-to partner for the biggest names in tech, period.
And hey, if that wasn't enough to get your attention, here's another jaw-dropper for you. 625%.
Yeah, that is their year-over-year revenue growth. I mean, this isn't just impressive, right? It's a sign of absolutely explosive demand and some incredible execution. And get this, that's even before that massive Microsoft deal fully kicks in. Wow.
So all of this, it naturally leads to a really crucial question, right? Where on earth did this company come from? And with this kind of crazy momentum, is it maybe the smartest bet you can make in the high-stakes game of AI infrastructure? Well, we're going to break it all down.
All right, so here's the game plan. We're going to start with their pretty unique origin story. Then we'll dive into what they call their full-stack advantage. We'll put them head-to-head with their biggest rival, deconstruct that big valuation, take a hard look at the risks, and then, we'll get to a final verdict.
Okay, first up, the origin story. Because, look, to really get Nebius, you have to understand where it came from. And that's the Russian internet giant Yandex.
Now, it's super important to understand this. This wasn't some kind of fire sale. It was a really strategic move, an unbundling. Nebius basically inherited a team of over 500 engineers who had spent decades building one of the largest cloud platforms outside the US. And that deep institutional knowledge, that's their secret weapon, for sure. And they didn't just inherit all that engineering talent. They also got this whole portfolio of other stuff, what they call non-core assets. We're talking things like an autonomous vehicle platform, an edtech company, and the whole thing is valued somewhere between $2 and $4 billion. This gives them this incredible financial flexibility that, honestly, a lot of investors might be completely overlooking. Okay, so let's see how all of that history builds into their main strategy. It's what they call the full stack advantage. And believe me, this is what really separates them from the pack.
So what does that mean? It means Nebius controls everything. From the custom-designed hardware, the actual racks and cooling systems at the bottom, to their own proprietary software in the middle, all the way up to the application services that their customers are using day in and day out. This kind of vertical integration, it creates something called operational lock-in. It's a fancy way of saying it's just a lot harder for their customers to pack up and leave.
And here's the real kicker, the ultimate prize. Because they own that entire stack, Nebius gets to keep way more of the profit. This gives them a totally plausible path to getting software-like gross margins. We're talking 60 to 70%. That's something their competitors, the ones who just lease and resell hardware, they can only dream about numbers like that.
Okay, so you really can't talk about Nebius without bringing up their biggest rival, CoreWeave. So let's do it. Let's put these two neo-cloud titans head-to-head and see how they stack up.
Man, this table really tells a story, doesn't it? You've got Nebius, who owns its infrastructure outright. That gives them a super clear path to those high margins we just talked about. Then you've got CoreWeave, on the other hand, who relies heavily on debt and leasing. Get this, their financing costs are actually higher than their return on assets. That's tough. Plus, Nebius is spreading its bets, diversifying its customers, while CoreWeave gets almost all its revenue from just 2 major clients. Big difference.
And hey, don't just take my word for it. Wall Street is really starting to take notice. Seaport Research, for example, came out and said that Nebius leads on the metrics that matter most: customer mix, unit economics, and the strength of their balance sheet. The market is definitely waking up to these huge differences.
So that brings us to the big question. What are investors actually paying for with Nebius's $29 billion valuation? Let's deconstruct it, piece by piece.
Okay, when you really break it down, a massive chunk of that value, we're talking up to $17.4 billion, comes directly from that Microsoft deal. That's contracted, predictable revenue. Then, you add in their fast-growing core business, and you toss in those valuable non-core assets we mentioned earlier.
So this kind of weighs out the different ways this could go. You've got your base case, right, where they just deliver on the Microsoft deal. There's some potential downside there, sure, but it seems manageable. But the bull case, That's where things get really exciting. If they can land just one more major customer like that, the potential return becomes really, really significant.
Now, I know what you might be thinking. On the surface, Nebius looks kind of expensive, right? It's trading at a way higher trailing revenue multiple than CoreWeave. But, and this is the key, once that Microsoft revenue is fully online and humming along, its forward multiple just drops dramatically. Suddenly it starts to look much more reasonable, maybe even cheap, assuming, of course, that they execute.
Of course, no investment is a sure thing, and this is no different. So let's be realistic and take a clear-eyed look at the challenges that could totally derail this incredible growth story.
Okay, first and foremost, you've got execution risk. Scaling up from where they are now to handle the full Microsoft contract is a massive operational lift, no joke. Then, future growth is probably going to require more capital, and that could mean diluting shareholders. And you have to remember, the whole bull case really hinges on them winning more of these huge deals, and that's just not guaranteed. Not to mention, if there's a broader slowdown in AI spending, well, that would impact the entire sector.
So, all of that brings us to our final verdict. Let's try to synthesize everything we've talked about and boil it down to one core question.
I mean, listen to the CEO himself. He's already set the expectation pretty high. He's on record saying he sees the Microsoft deal not as a one-off thing, but as the first of many contracts with leading AI labs and big tech companies. So, at the end of the day, the entire bull case really hinges on one thing. Do you believe he can deliver on that promise?
So here's the final thought to leave you with. Nebius has a really unique model. They've got a world-class team, and now they have this landmark contract that gives them a super solid foundation. The question you really have to ask yourself is this: are they building a sustainable, long-term kingdom in the AI infrastructure space, or is this just a single, heavily fortified castle in a vast and really competitive land? I guess we'll find out, because the answer is going to unfold over the next 12 to 18 months.